that the stance of monetary policy can have substantial effects on the determination of the optimal tariffs. And if monetary policy is determined in a way that is committed to, for instance, we have something like a Taylor rule, we show that that can lead to a substantially lower degree of protection from the point of view of a single country. Now, if we throw that into a trade war, then the overall equilibrium rate of protection in the kind of trade war scenario where countries respond to each other's tariff choice, then that can actually lower the costs of trade wars substantially. So it's a very kind of indirect effect.
If the monetary policy targets CPI inflation, the response is magnified because more weight is given to imported goods, was price rises. This is going to lead the tariff setter to set further lower tariffs. And in our Journal of Monetary Economics paper, we consider this case because CPI inflation targeting is more realistic. Also, PPI is usually the optimal target in most settings, but without tariff, even in open economies, as anyone can find in the literature. So again, theoretically, yes, central bank can extinguish all incentive to apply tariff, but with some cost.
In the paper, what we do is, once we establish all these theoretical results, we take the model a little bit more seriously and we take it to the data. So we estimate the model using Bayesian methods on the pre-2018 period, in which tariffs have started to rise between the US and China. And this is like to get a benchmark of the model. And then we throw in the trade war equilibrium, and what we get quite right, actually, is the level of tariff that ensues from this set of parameters. So the model is really good at replicating the observed level of tariffs that China and the US adopted. What is a bit less impressive is that compared to the theoretical section in which we said, CPI and PPI inflation targeting deliver very different outcomes, here we find that for the parameter values that we estimate, actually the difference is not very significant. And the second point is the welfare cost of tariffs is relatively small. And that's because in the simulations, the bilateral trade openness between US and China is relatively small, and because of that, the scope of tariffs remains relatively limited. So the fall in trade flows, if you want, is relatively limited as well, and the welfare costs are relatively modest.